Okay, those were the big headlines that we will be tracking for you all day on ET Now today. Let's welcome now on the show Hemant Rustagi of Wiseinvest Advisors to talk about the topic that I told you about, and that's mid-cap and small-cap mutual funds. It's a tricky portion to invest in, especially in the last 3 to 4 years. So, Mr. Rustagi, thank you so much for joining us today on ET Now to sort of decode the kind of performance we've seen in this segment. Yes, in the last 1 year, you put your finger on any category of mutual funds and it's largely rallied. But if you extend the time horizon, and many of our viewers who've started investing, especially in 2016, 17, are going to be very disappointed with this segment. So, in the last 3-4 years, and in fact, even now, Mr. Rustagi, if we have to compare what mid and small caps have done versus what the large cap index has done, there has been underperformance. What do you think that is the reason behind it?
Well, I think if you really have to analyze the performance of large and mid cap and compare that with the large cap counterparts, see, I tell you there are two things. If you look at a 1 year basis, they're almost at par. Okay, I wouldn't say that they were underperformed. Yes, if you look at 3-year performance, and the reason why I'm mentioning 3-year performance roughly around 2 to 3 years is because Jan 18 is a time when both the small cap and the mid cap indices peaked. From there, if you really compare, yes, they have underperformed. In fact, I would say that from 15th of Jan 2018, if you were to see Nifty 50, it's up almost 46%. And if you look at Nifty Mid Cap 100, it's around up only 7%, and the Nifty 100 Small Cap is down around 17%. Now, clearly, when you look at 3-year performance, yes, they have underperformed. I think there are a couple of reasons for that. One, as I mentioned, Jan 15 is a time where around that time both these indices peaked. Thereafter, there were a couple of reasons why these segments have not done well. If you recall, in that year budget, there were reintroduction of long-term capital gain. Then there were a number of domestic as well as international economic as well as geopolitical issues followed by COVID. These were obviously a time, and in fact, if you recall, before COVID also, for almost 1 year, around 15 months, the market breadth was very narrow. There were only a handful of stocks that took the market up. So clearly in that kind of scenario, the mid caps and the small caps have underperformed. But if you go a little longer, say around 5-year, 10-year, 15, the average return given by these funds is still better than their large cap counterparts. Of course, the point is that when you look at mid cap and small cap, these are very aggressive segments of the market. While the companies in these two segments have the potential to do very well, there are obviously also attendant risk of volatility as well as underperformance, especially in the economic downturn. So that's the period where the economy was not doing very well, the market was quite narrow, and that's the reason. And I think another reason why investors are seeing not so encouraging returns are that if they invested, let's say, towards the end of 2017, and they've not followed it up with any investment further, they are the ones who are actually seeing the disappointing results. But trust me, anybody who was investing through SIP, if they continue to invest, I think their returns have been much better.
Okay, so basically, Mr. Rustagi, for let's say those individuals who started investing, like you mentioned, after 2018, or maybe even before that, because these are the guys that have picked up units at the peak, but then slowly the returns have been tapering off. You're recommending that they should stay absolutely put in their investments in mid and small cap funds?
Well, absolutely. I think in terms of potential, definitely yes. But I think whenever you talk about your own portfolio, there are a couple of things that you need to look at. One is you need to look at the kind of funds which are there in the portfolio. What is the level of exposure? As I mentioned earlier, the companies in these two segments have the potential to do, in terms of growth better than the large cap counterparts, but of course there are attendant risks. So you need to be very clear in terms of what kind of fund you have, what's the quality of the portfolio, and the manner in which you have been investing. As I mentioned earlier, if you made one single investment and you did not follow it up, because the segments were not doing very well, you missed out on a great opportunity to average it down. Of course, you can never time it. That's why it's very important that if you are very sure about your exposure, level of exposure to these two segments, you are very clear in terms of selection of funds, and if you continue to invest in a disciplined manner, these two segments have the potential to give you very good returns. So I would say that every investor who is disappointed with the returns right now should have a close look at the portfolio. Look at the level of exposure. If the level of exposure is too high to to suit your risk profile, you need to pare it down maybe. If the fund performance has not been consistent, maybe relook at some other fund. But you must have exposure to these two segments, but at the right level, and also, like I mentioned, follow a disciplined process of investing.
I understand I threw a bit for googly at you by, asking you an absolute yes or no kind of question. Of course, it always depends on every individual, the kind of funds they already have, their risk objective, what their risk appetite, their objective as well for investing, how long can they invest for, so on and so forth. All of that has to be considered, and, then you sort of take a decision. Mr. Rustagi has mentioned some of the parameters. You spoke about how, depending on your risk appetite, you should adjust the amount of mid and small cap funds in your portfolio. So let's say somebody who has a high risk appetite, somebody who's maybe younger, and somebody who has a low risk appetite, somebody, who's maybe approaching retirement, is, about to, is now going to soon depend on these funds to be able to take him through the rest 30, 40 years of his life. How would you recommend they allocate, how much of their portfolio should they allocate to this category of funds?
Well, Bobina, important thing to understand for every investor is that equity as an asset class itself is quite aggressive. Okay, so when you're investing in an aggressive asset class like equity, you need to be very careful in terms of how much exposure you have, because there are three segments of the market. In my view, irrespective of whether you're a young investor or, at a stage where you still have 15, 20 years to build the portfolio, I think there always in the portfolio has to be a bias towards the large cap. The fact remains that you're talking about top 100 companies in terms of market cap. These are the companies that have existed for so many years. These are the companies that are going to exist for many, many, many years. So you don't want to be investing heavily into a segment where you're not sure about how those segments will do well. So clearly, the bias always has to be towards the large cap. So broadly, if I can say, maybe around 50 to 60% should be in large cap. The remaining can be in mid cap and small cap, and even within that, I would say around 60 to 70% at least should be in mid cap, and the rest should go into small cap. Clearly, when you are young, you can take slightly more risk, but don't forget that, like I mentioned, equity is an aggressive asset class. It's very important to understand the nuances of investing in equity rather than making your portfolio very, very aggressive at the initial stage just because the segment has the potential. I think keep a balance in terms of your asset allocation, and within asset allocation, keep a balance in these segments. And like I mentioned, always maintain a bias towards the large cap. Yes, of course, as you near retirement, you need to kind of maybe even rebalance that and increase your allocation to large cap. But don't forget, you have to remain invested in equity, and these two segments, even at that stage, will have a role to play. But of course, the level of exposure is very, very important, which can vary, which have to be rebalanced over different phases of your financial life.
There's another point that you actually mentioned, in your previous answer, and that was that if a fund is not performing very well. So how do you judge whether, a small cap or a mid cap mutual fund in my portfolio is not performing well? Because you mentioned that, yes, there is a little bit of underperformance, or there's more or less the performance has been in line with large caps. So how would I essentially be able to gauge that? What do you look at in a fund to gauge its performance?
I think this is a very important question from the investor's point of view. Two things you need to look at. One is, when you talk about underperformance, look at the performance of the segment that you're investing in. Now, we talked about last couple of years, the mid cap and the small caps have not done very well. So if your level of exposure is all right, in line with your risk profile, the fund that you've chosen for your portfolio are good, have a good quality portfolio. But just because the segments have not done well and your funds have not done well, it doesn't mean underperformance. I think first thing is something that you need to remember. Just don't look at negative return. Just don't look at single-digit return and say, okay, this fund is not performing well. First, look at which segment are you invested in and whether that segment has done well or not. If that segment itself has been under pressure, then you need to give it more tips. That's the starting point. Second thing is, how do I compare the performance of the funds in my portfolio and how do I know whether the fund is performing or not? Simple thing is that look at the peer group. Look at the average of the peer group. As long as the fund in your portfolio is performing above average, I think you should be all right. Because that's the most important thing. Now, why the average is important is because if, let's say, the average is 15% and your fund has given 12% or 10%, clearly there is an underperformance. But as long as it's giving above 15, I think just stay put. Second thing is, sometimes, different fund houses follow different philosophies within the segment also. Now, some can have slightly concentrated holdings, some can have more diversified portfolio. Now, at times when this segment is doing well, you may see the fund which is having concentrated holding will do better than diversified fund. Now, you can't just say because you have a diversified portfolio and that fund is not done well, you should get out. No. I think it's very important to look at from your own risk profile point of view. If you are investing in an aggressive segment and you want a diversified portfolio, you have to accept a little bit of underperformance because it will help you both ways. Maybe underperformance at the time when the segment is doing very well, but when the segment is under pressure, it will also give you some downside protection because it has a diversified portfolio. So look at these two factors before you kind of rush to decide whether your fund is not doing well or not.
Okay, all right. Well, you know what, we'll do one thing now. We'll take on both the questions and queries that, we'll receive for our viewers. But before that, we'll take a very short break. We'll wait for the questions to assemble as well. You can email us on themoneyshow@etnow.tv and we will get them answered. So, quick break on the show and be right back with your questions. Welcome back. You're watching The Money Show on ET Now. It's time to bring on board our viewer questions and queries. So let's get straight to that without any further ado. First up, we have a question from Rohit Mandhare, and he asks a very vital one. He asks, Hemant, what are the key points one should look at while selecting a mutual fund? Mr. Rustagi, what would you advise?
Well, again, I think very important question from investors' point of view. The best thing about investing in mutual fund is that there is a fund to suit every time horizon and every risk profile. Of course, to get the best from them, you have to choose the right one, and that's where I think I'm going to explain how you can do that. See, when you talk about mutual funds, there are a variety of funds. There are debt funds, there are hybrid funds, there are equity funds. So before you invest in them, the mistake that we make many times that we straight away jump to the product that we want to invest in, the fund that we want to invest in. Many times we do that depending on how the markets are doing. So I think that's something that needs to be avoided. The most important factor that we need to look at is suitability. How do you ascertain suitability? You need to follow a process for that. One, you need to define your goals. You have short-term goals, medium-term goals, and long-term goals. Define each one of them. Assign a time horizon to each one of them and set a target for them. But this process will help you decide your asset allocation. When you're investing for the short term, your focus has to be on protection of capital. In the medium term, you're looking at both the protection of capital and growth. And in the long term, because the basic objective is to get positive real rate of return by beating inflation, the focus has to be in equity. See, the moment you do this process, you know exactly how much money has to go into different asset classes. Once you have done that, let's say we're talking about equity here. When you know that you're investing for a longer term, maybe 15 years, 20 years, depending on what your goal is, even if let's say it's your retirement planning, within that, as I mentioned earlier in the show, that equity by itself is an aggressive asset class. You need to be very careful in terms of the funds that you're choosing. So you start with diversified category of fund rather than straight away jumping into or investing into a thematic fund or sector fund. Avoid those exotic kind of fund. Could go for diversified fund. It could be multi-cap, it could be large cap, it could be even a collection of large cap, mid cap and small cap. Once you've decided that, how do you choose a fund? You choose a fund based on, like I said, you've already looked at suitability. The second important part, of course, is performance. But while looking at performance, don't look at short-term performance. The problem with the short-term performance is that when the markets are doing well in the short term, you will end up investing aggressively. When the markets are not doing well in the short term, you will end up not investing in equity. So look at a longer-term performance, maybe 5-year, 10-year, 15-year. Go for the funds which are very consistent in performance. As I mentioned earlier, the best way to see whether the category of the fund you have chosen is doing well or not, compare the performance with the peer group. And as I mentioned, look at the long-term performance, don't look at short-term performance. So these are broad two factors. In the debt, there are 16 category of debt funds. Of course, you need to look at each fund very clearly mention what kind of maturity duration it's going to have. So you make sure that the time horizon that you have matches with the maturity duration of the portfolio. So these are the broad parameters that you need to look at. It's equally important to monitor the performance of the fund as the selection of the fund is performance. Many times, we ignore this aspect. So both the selection and the monitoring, both are important.
Okay. After the selection, there's monitoring as well, which, like Mr. Rustagi rightly pointed out, is something that must be done too. So the game doesn't end at selection. Monitoring is equally important. Well, most of our viewers do tend to do that because they keep writing into us with their portfolios. So we are happy to help them out with that. Here's one such question. We have Prakash Agarwal who writes in saying, I've invested 5 lakh rupees each in the following funds. He's done this in the end of 2017, so it's a lump sum investment. Now he says he also flags up that they've been performing below average. Please advise if I should switch or hold. All growth funds, SBI Blue Chip, Kotak Standard Multi Cap, Franklin India Prime and ABSL Equity Hybrid 95. Prakash hasn't really mentioned anything about his goals, but 2017 end, it's already been 3.5-4 years, so we'll assume that he's a long-term investor. What do you think, Mr. Rustagi? Do you think that these funds, warrant more patience?
Well, a couple of things. As we mentioned earlier, that the earlier peak was there in Jan 2018. So if somebody is invested towards the end of 2017, we'll see some kind of disappointment, especially if there is only one investment which has been made and not been followed up. So that's something that he needs to keep in mind. If I look at his portfolio, the couple of funds that he can actually retain in the portfolio, one is SBI Blue Chip. He can retain, it's a decent fund. The second is Kotak Standard Flexi Cap Fund. It's become a Flexi Cap Fund right now. So these two can be maintained. If the other two funds, one is the Prima Fund, which is the Mid Cap Fund. I'm assuming here that he wants to continue in the same category. Then there are better funds which are available. So one fund that I can recommend to him in place of Franklin Prima is Kotak Emerging Equity Fund. It's a good quality fund. It's been performing very well. He can actually think of moving in there. And in terms of equity hybrid fund, I believe that compared to the fund that he has in the portfolio, Canara Robeco Equity Diversified Fund can be a better fund. He has completed almost, I would say, 3 years. As I mentioned, these 3 years have been a bit tough for certain category of fund. But in terms of pure performance, in terms of quality, I think these are the two changes if he makes, provided that he still has the time horizon left, which is suitable for equity investment or equity, balance kind of portfolio. He can make these two changes. He will certainly see improvement in the portfolio return.
All right. Okay, so I hope Prakash ji has heard you out and, pays heed to your advice. Well, on that note, we are actually a bit short on time, so we'll have to wrap it up. To all our viewers whose questions we've not been able to take, don't fret. We'll be back tomorrow same time to help you out with your questions, so stay tuned. And Mr. Rustagi, thank you so much for joining us today on The Money Show.
Thank you.
And with that, we will take a very short break right here on the show, but we will be back continuing our conversation on small cap and mid cap funds. Don't go anywhere.